Thank you for joining this presentation on master budgeting. And the method that we're going to introduce today consolidates two fundamental concepts of budgeting. And this is the percent of sales method and additional funds needed. So you can go through and look through the notes to get an idea of conceptually what's involved. But this presentation is going to go through the mechanics on how to perform the percent of sales method and determine the additional funds needed. So here's just a simple example of an income statement, statement of owner's equity, and balance sheet. We want to use the base, and you could see that's in column F. We want to use the base to create a forecast based on that base. So first thing then to notice is to see that I have some cells highlighted. So for example, if you look on cell F6, you will see 400. And there I have a calculation, no inputs. What does that mean? So if I clicked on cell F4, you can see right here that I typed in the number of 1,000. Down here on F5, again, you can see that I typed in the number of 600. But what about cell F6? That's a formula. So that's going to be the 1,000 minus the 600. So that's going to be important. Whenever we have calculation, no inputs, we want to skip calculating the percentage of sales for those because it's a formula already within the spreadsheet. Now, to go out there and do our forecast, we have to know which numbers are input. So for example, operating expenses. You see up here, we had to type in the 200. Interest expense, we had to type in the 50. So also, you can see then that there's a flow of information. So you calculate the net income from the income statement. The net income flows into the statement of owner's equity. You calculate the statement of owner's equity, and the ending owner's equity flows into the balance sheet under the owner's equity section. So just a normal flow for your financial statements, but we want to use that to help create a forecast for this company. The fundamental rules that you understand to construct financial statements don't change in this instance. So you can go out there then and use that to help you forecast. So let's go down. So we're just going to repeat this and keep adding to it. And let's look at this column here. And you could see that I've calculated some percentages. So for example, your cost of goods sold, you remember that we typed in the 600 there. Whenever we type in a number in the base, that means that we have to calculate the percent of sales. So for example, your cost of goods sold, where did we get this 60%? 60% is equal to 600 divided by 100. 20% on your operating expenses is equal to 200 divided by 1,000. Interest expense, 50 divided by 1,000. Income tax expense, 50 divided by 1,000. So that's how we get the 6%, 20%, 5%, and 5%. What is the underlying assumption for the percent of sales method. The underlying assumption is that those percentages will never change. Your cost of goods sold will always be equal to 60% of your sales. Your operating expenses will always be 20% of your sales. Now that's a fairly strong assumption, and you could have fixed costs within your financial statements. We don't have any fixed costs here in our financial statement. But again, we assume that these percentage of sales percentages will remain constant over time. And we want to use that relationship to help us forecast. So you could see then that everything here remains the same, and we just added the percentage of sales. So let's move down. And basically, what I've done is I've copied this column over into this column. I've copied this column over into this column. Why? Because it has all the formulas. The formulas are set up in the base that I want to use in the forecast. Now, here's the point that's going to cause some problems when you construct your forecast using the percent of sales method. And if you could see right here, it's the ending owner's equity. By definition, the base year ending owner's equity has to be equal to the forecasted beginning owner's equity. So for example, if this was the 2021 base year, then the 2021 ending owner's equity has to slide up to become the 2022 beginning owner's equity. And so this you could see as a cell reference. Basically, where does this number come from? It comes from here. The net income slides down again, and the dividends are 5% of the forecast. Why does this create a problem? Because of this relationship, this ending owner's equity by definition is this beginning owner's equity. You see now that the owner's equity slides down from the statement of owner's equity into the balance sheet. What's the problem? The fundamental accounting equation doesn't hold anymore. Remember that the fundamental accounting equation says that your assets have to be equal to your liabilities plus owner's equity. Assets must be equal to your liabilities plus owner's equity. In our forecast, assets are 3,000, liabilities and owner's equity are 3,050. So we're violating the fundamental accounting rule. So we're going to have to fix that. And again, what's the cause of this imbalance? It's this relationship right here. The base year ending owner's equity must be equal to the forecasted beginning owner's equity. So how are we going to solve for that then? We want to introduce a plug number. And in our example, let's look down here on slide 117 there. And the plug number in this example is long-term debt. The plug number could have been any number, almost any number. And you usually want to put the plug number into the balance sheet but I could have easily have chosen current assets, long-term debt, long-term assets, owner's equity, not too much, but any number could have been the plug number. And you see that the balance sheet, just a very condensed balance sheet. But if you had many items in your balance sheet, you could chose any number as a plug number. What's the purpose of the plug number? The plug number basically forces your assets to be equal to your liabilities plus owner's equity. The plug number is a force number to make sure that your fundamental accounting equation still holds. So in our example then, the plug number is equal to 2,400. And we see now then that our total assets are equal to our total liabilities and owner's equity. How did I calculate this plug number? And so let me do this. You can see that to calculate the plug number, that's equal to total assets minus owner's equity. And that's going to give us 2,400, which forces the assets to be equal to the liabilities plus owner's equity. So you need to understand that it's not always going to be this formula for the plug number. You're going to have to be clever and figure out, how do I set up a formula within the plug number so that my assets are equal to my liabilities plus owner's equity? And in this case, very simple. It's total assets minus owner's equity. But in other cases, it could be more involved than what you have here. So it's not always easy. It's not always easy, but it's going to take an understanding to determine what the plug number is. In our case, it's easy. Sometimes it could be complex. Now, let's move down here. And let me show this whole sheet and make this a little bit smaller. So hopefully you can see all of that. So we have a forecasted sales number of 2,000. How do we calculate our cost of goods sold? Remember that the underlying principle of the percent of sales method is that these percentages will stay the same. They will hold constant. They will hold constant. Cost of goods sold will always be 60% of your sales. Operating expenses will always be 20% of your sales. So, how did we get this cost of goods sold number of 720? 1,200 times 60 is equal to 720. Operating expenses, 1,200 times 20% is equal to 240. Interest expense, 1,200 times 5% is equal to 60. And income tax expense, 1,200 times 5% is equal to 60. Now to the statement of owner's equity, the beginning owner's equity, because of the previous ending owner's equity, beginning owner's equity is 550. Net income flows from the income statement into our statement of owner's equity, just like here. Dividends are equal to 1,200 times 5% is equal to 60. 1,200 times 5% is equal to 60. Current assets, 1,200 times 50% is equal to 600 long-term assets. 1,200 times 250 is equal to 3,000. So total assets are equal to 3,600. Our owner's equity right here, that's going to flow from the statement of owner's equity into the balance sheet. And again, the plug number is the number that forces your assets to be equal to your liabilities plus owner's equity. So in our example, assets are equal to 3,600, liabilities and owner's equity, they're equal to 3,600. So therefore then, we see that our fundamental accounting equation holds because of the plug number. Now let's look at long-term debt. So the forecasted long-term debt, 2,990 from here down to here. The original long-term debt comes from here, cell F147. So forecasted long-term debt minus base long-term debt gives us additional funds needed of 540. So to go from here to here, the company will have to borrow an extra $540. The company needs to borrow an extra $540 to support the sales of 1,200. For whatever reason, they might have to buy additional property, plant, and equipment, or it's going to take something else. But the company needs to borrow an additional $540 to have sales equal to 1,200. To have sales equal to 1,200. All right, now here comes the beauty of the percent of sales method. So we can see now that it takes a lot to go out there and construct your forecast. It's not easy. It's not easy. It's tedious. I think that's the correct word to use. So understand that everything has to be in place for this to be correct. But now, once you've gone out there and set up your forecast, then the beauty of the percent of sales forecast method comes into play. So let's say then that instead of the forecast being 1,200, we want the forecasted sales. The forecasted sales, instead of being 1,200, we want the forecasted sales to be equal to 1,500. So all I need to do now then is to change the sales forecast to 1,500, hit enter, boom. The forecast is updated for us fairly quickly. How do we know we must have done it correctly? Again, our assets are equal to our liabilities plus owner's equity. Our assets are equal to our liabilities plus owner's equity. So we're meeting the requirements of the fundamental accounting equation. And for our additional funds needed, now the plug number is 3,875. Original base long-term debt, that hasn't changed, that's 2,450. So additional funds needed tells you that you need to borrow 1,425 to support sales of 1,500. If you want your sales to go up, you're gonna have to spend 1,425 within your company to increase sales for your business. And again, let's try this again. Let's make our sales 2,000. So we want to change our sales forecast to 2,000. We can see then that the forecast is updated for us automatically. The forecast is updated for us automatically. So the percent of sales method facilitates the additional funds needed. The percent of sales method facilitates the additional funds needed. It works the other way also. So let's say then that sales this year are 1,000. Next year, we only expect them to be 800. Let's change the sales forecast to 800. Does our master budget still hold? Yes, it does. Yes, it does. And how do you interpret this then? If our sales are only going to be $800, down from 1,000, we have additional funds needed. That's a negative number. So instead of having 2,450 of debt, you could see right here, instead of having 2,450 of debt, we only need 1,810 of debt. So we can go out there and pay off part of our debt because we're not going to need the extra equipment, the extra sales, so on and so forth. So why have that debt? So let's take that debt off of our books because our sales are only going to be 800 and we're only going to need 1,810 of long-term debt now to support those sales. So the scenario analysis that is afforded to you by the percent of sales method is excellent. So we'll say then that in our case, the worst case scenario is that sales will only be equal to 800. The base case is that sales will go up to 1,000. Then let's do a best case scenario. Let's say that the best case scenario is equal to 1,500. I just made up that number. It's equal to 1,500. Hit enter. And again, all the scenario analysis can be done for you very quickly once you've constructed your percent of sales forecasting template, and the additional funds needed you can see is calculated for you automatically also. So there are many benefits to the percent of sales method. And again, the quickness of scenario analysis is the main benefit. The quickness of the scenario analysis is the main benefit. What are some of the weaknesses? Again, the main premise of the percent of sales method is that these percentages will not change over time. Cost of goods sold will always be 60% of sales. Operating expenses will always be 20% of sales. That's a pretty strong assumption. That's a pretty strong assumption. But that's the assumption necessary to make the percent of sales method work for your master budgeting. And the other downside to the percent of sales method, tedious to construct. Tedious to construct. And if you make one mistake, it's fairly unforgiving. If you make one mistake as you construct your forecast, it won't work. So easier said than done. Don't make any mistakes. when you're constructing your forecasted financial statements. So this then is the percent of sales budgeting method integrated with the additional funds needed. You can look that up in your book, and they may treat it as two different topics, but you can see both of them are pretty important, and our spreadsheets will integrate them into one spreadsheet.